For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. We have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disability. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this program.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I'm Possible, where we managed to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us than paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients in their family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. Join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Hello everybody, welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today our webinar's title is Manage Your Own Portfolio Like a Pro. So welcome everybody, my name is Shen Chu, I'm the moderator for this webinar. So in this session, our speaker is going to share with you how do you manage your portfolio, your investment portfolio like a fund manager, like a professional. So that's the objective of this session. So before we begin, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. So allow me to briefly introduce our speaker. And our speaker today is a trader and investor in the capital market. He is a founder and chief master trainer of the Street Finance. His signature program, which is Street Trader Intensive, has allowed many individuals to trade without monitoring and speculating in the market. It is often featured in media such as City Plus FM, Borneo Post, Sinchu Daily, etc. And he is often invited to speak for Bursa Malaysia and other investment banks. And he's also a frequent speaker in universities and colleges nationwide. So it's none other than Mr. Bong Jin Hao. So Jin Hao, good to have you here with us today.
Hello everyone. Hi Shane. How's everything?
Yeah, I'm good, and you?
Okay, so I need to share from my side, right?
Yes, that's correct.
Okay, so hi everyone. Welcome to the webinars tonight. First of all, thank you Shane, and also thank you Bursa for having me here today to share with you. All right, I think this topic comes in, really at the right timing, because like it or not, Bursa market right now, okay, actually is the stock market in general. Okay, stock market in general is, performing not really that, I wouldn't say it's bad, but it's not really like what we have seen in, 2020 or even 2021. Okay, so if you are ready for tonight's session, can you please just type ready in the chat box? All right, type ready in the chat box. Okay. All right. So I need you to participate along, okay, in this entire webinar so that you learn better, okay, just to stay attentive. All right. So remember, when you stay attentive, okay, when I ask you to answer some questions, okay, to type something, okay, it is just for you, okay, to stay attentive, make sure you are here with me, and also to enhance your entire learning experience. All right, so just to check, can you see my slide? Okay, can you see my slide? Am I sharing the right screen? All right, so if you can see the content outline, can you please type C? C stands for content, just want to make sure. All right, okay, cool. Okay, thank you. Okay, so tonight's session, okay, today's session, I think it really comes into a nice timing, because right now, okay, like it or not, the market is not really that bullish, but at the same time, we are not really like, in a super bearish market whereby the market is crashing or things like that, although the performance of the market has not been really that up to a lot of people's expectations lately. But nonetheless, tonight's session is going to be a very important one if you're looking forward to manage your own portfolio, like how the fund managers do, like how the professional traders do. Now, I learned this from fund managers themselves and also some of the professional traders, okay, who really trade a lot of, portfolios and also manage their own portfolios, with multiple millions one, okay? So this is how I manage, okay, our portfolios as well when it comes to trading or even investing. Okay, so here are the outline. First one, what separates professional traders and amateur traders? Okay, you want to be a professional. The first thing is you need to know how professional thinks as opposed to how amateur traders or the mediocre retail traders out there, okay, how they think. Right, so how to manage your own portfolios like a fund manager. So we talk about diversification, we'll talk about position sizing, we'll talk about how do you make adjustment along the way. The third is when to add or reduce position when necessary. Okay, and last but not least is I'm going to show you, give you some ideas, give you a heads up on how you can create your own trading system. Okay, so because you are already in the market, you know what works and what doesn't. So you are trading with whatever rules that you are using. Like for example, you use MACD, you use RSI, you use stochastic, you use moving averages and things along those lines. So how can you implement all this into a portfolio managing environment, a proper portfolio managing environment, okay, by creating your own trading system. Okay, so let's get started. All right, now, the first thing that I want to let you know is professional traders, okay, they think from a business perspective. Okay, they think from a business perspective. Now, for example, this is the iPhone 14. Okay, let's just assume this is the iPhone 14. Now, I have a question for you guys. Okay, I have a question for you guys. If just assume that you are a mobile phone store owner. Okay, mobile phone store owner. So you have a lot of this iPhone 14. Okay, because 15 is coming out soon. So let's just assume that you have a lot of inventories for iPhone 13 or even iPhone 12 or iPhone 11. Okay, meaning that old generations, okay, they are not the hot selling cakes anymore. Okay, so you have all those old models in your inventories. Okay, now my question to you is, are you willing to sell off your iPhone 11, iPhone 12, iPhone 13 at a slightly lower prices to recoup your cost, get some cash so that you can increase your inventory of those models that are hot selling right now? It could be 14 or 15 in the very near future. So my question to you is, are you willing to do that? Yes or no? Type in the chat. All right, yes or no? Type in the chat. Are you willing to let go your current inventories of old models so that you can recoup some costs and buy new inventories of those new models, like for example 14 or even 15 in the near future? So here's the thing. If you are standing from a business perspective, okay, my question to you is, why are you still keeping your old inventories like iPhone 10 or Huawei Mate 9? Okay, so whereby you know that it's not going to sell at the price it used to be. Okay, so that's the thing. You got to think from a business perspective. All right, think from a business perspective. If this happens to your mobile phone store, okay, are you going to do that? If you want me to give you an answer, the answer is definitely a yes. Because there's no point to keep all models hoping to sell at the same price again if you know that they are no longer going to be, the hottest thing in the market right now. Now, same goes to trading. Okay, same goes to trading. Especially if you're in trading and not investing. If you're in trading, if a stock is already dry up, the volumes has already dried up, there's not much liquidity, people are no longer talking about the stocks, the price is already going down, it's not favoring your direction, you should, by right, have to, by right, you have to sell off those shares at a loss. This is what we call a stop loss, so that you recoup your capital back, okay? And then you can invest or trade those stocks that are trendy right now. They are having momentum right now, okay? There's no point, okay, hoping your old Nokia 3310 to go up in price and then you'll hold like 10 years, okay? But not all the phones are going to be like Nokia 3310, whereby it becomes an antique that suddenly has value, okay? If you, there's a lot of traders out there I met, okay? They are keeping a lot of old stocks, hoping that one day they will go up so that you recoup, okay, the cost. Okay, so that's the thing that I want you to think, okay? Especially if you're a trader, you got to think from a business perspective. Okay, you got to think for a business perspective. So some Jam asked in a question, okay, what about looking at the longer term? Like I said, okay, hold for a few years. Then I ask you, what conviction do you have on the stock that you are holding? Are you willing to accept that if you are wrong. Like, for example, a lot of people are still thinking that NFT will one day go up. I'm not saying that you are right or wrong, but just understand that when you have your capital locked inside, that's an agreement that you do with the market. Okay, not me, not your brokers, not Bursa. Okay, so my question to you is, what conviction do you have? Okay, to the stocks that you're holding for quote unquote long term. Okay, now of course, the next few things that we want to address, okay, apart from this iPhone example, is which one is better. Do you think that a scalable business is better or non-scalable business? Scalable type 1, non-scalable type 2. Okay, which one do you think is better? Okay, definitely scalable business is good. So scalable business can be like, most of the e-commerce out there, or if you're doing things like, franchise, whereby a lot of times just increase the number, okay, and put more capital, increase the number, and then, introduce more workforce. A non-scalable business can be a lot of, self-employed, like if you are a dentist or a doctor, you're a professional, okay, you can do whatever clients you have, but it's quite hard to expand. Now, of course, if we think at a bigger picture, scalable business is the way to go. Now, at the same time, investing or trading also have to be scalable. However, many retailers never put this into perspective. You give him a 10,000 ringgit portfolio, you give a 20,000 ringgit portfolio, he can trade, no problem. But suddenly, trade, okay, 10,000, 20,000. I met a lot of people like this. During the glove rally, okay, they can grow like 10,000, 20,000, 50,000. They grow. They've really flipped their account, okay, like from 20,000 to 40,000 to 50,000 because they get into top glove. They get into like, glove counters, healthcare and whatnot, okay? And they gain some kind of like, confidence from that rally, okay? But they do not have this kind of business perspective inside. They don't know how to really handle risk and how to handle a portfolio. So the next thing is they're going to withdraw their fixed D. They withdraw their unit trust, and then their 50,000 portfolio suddenly become like 250,000, 300,000, 500,000. Withdraw the EPF. Okay, suddenly the size become big, and they have no idea how they can manage this portfolio, and they are still using the way that, I got to buy 1, 2 counters, hope that it will go up 10, 20, 30, 50%, or even 100%. And that's where things, start messing up. Okay, so successful scalable business rely on system. Okay, rely on system, which consists of a series of SOPs, and professional portfolio managers also have similar system that guides and grows their portfolio. And this is exactly what you will be learning later. Okay, what you'll be learning later. But before that, I want to show you another thing to really let you know what sets aside amateur traders and profitable traders. Okay, so are you ready? If you are ready, can you please type number 6 in the chat box? Type 6 in the chat box. If you're ready, type 6 in the chat box. Okay, now, this is what I have learned from my mentor, and we verify it by interview a lot of traders. Okay, a lot of traders. And this is what inside the mind. Okay, what inside the mind. Now, if you are using a computer, having a keyboard, okay, then participate along. Okay, now, amateur traders and profitable traders, okay, which one do you want to be? Amateur or profitable? A or P? A or P? All right. Profitable, to be profitable, you need to be professional as well, right? You need to be professional as well. All right, so let's get started. Now, first thing, amateur traders, what do they often look at? What do they often look at? Now, I give you a clue. When you log into your broker's platform, okay, whatever broker you're using, Kenanga, UOB, MBank, Public Bank, okay, whatever thing, okay, what is the first thing do you think amateur traders will look at? The first thing when they log in, what will they go and find and look at? What's the list of stocks that they will look at? Anyone? Not blue chip, okay. Very natural one. One thing that very natural that an amateur trader will look at when you log into a platform. The things start with top. Top what? Top gain, okay. Top gain, top volume, top return, top volume. Come on. Beautiful story. Top, top selling. Okay, now, most amateur traders out there, okay, they will look at top volume. Okay, top volume. Now, this is a very typical one. I don't know whether nowadays, okay, because I'm not from the West Malaysia. I'm from small city, and in my city last time, okay, there really be a group of traders that go to the broker firm, okay, group of people, okay, clients. They will go to the broker firm. There are a few PCs there. They always focus at top volume. That's where you get a lot of penny stocks, okay, and then buy, sell, okay, and after 1 year, don't make money. Okay, now professional traders, we see things differently. Okay, and this thing, okay, last time I wasn't profitable. And the first thing that I learned from my mentor is this, and instantly changed a lot of things. Instead of looking at a top volume, skip it. Because like it or not, a lot of time top volume don't help you. Okay, don't help. Okay, now we look at top gainers. Now, very simple. If you see certain stocks, like 1 week, 5 days, it comes out 3 to 4 days. Okay, that particular stock come out 3 to 4 days. What does that mean? Okay, you got to think. What does that mean? Okay, what does that mean? As opposed to you see the stock out of 5 days, 4 days come out in top volume. Today red, top volume. Tomorrow red, top volume. The next day green, top volume. Okay, versus gainers. Which one do you think is more powerful? Okay, which one do you think is more powerful? Try to recall last time the glove or the tech rally. Do you think that if you know nothing about the market, but the glove stocks appear 4 days out of 5 days in a week inside top gainers, do you think that this actually give you a lot of hints that what things or what stocks or what sectors are moving in the market? Okay, this is a very important thing, okay, that you need to understand. Okay, so again, these are the differences. Now the next thing is what makes, okay, amateur traders take entries. What makes amateur traders take entries? Okay, what's the decision making thing that let them press the buy? Okay, a lot of time amateur trader, they go on tips, they go on rumors, they go on news, they go on feeling, they hear someone say, they see the tips from someone, okay, ask their reminder, hear the rumors from whatever thing. Okay, that is most retailers out there. If you're not in this category, then congrats, meaning that you are better than amateur already. Okay, you're already doing a lot better than those people out there. So professional traders, profitable traders, what makes them take entries is the entries are always made based on analysis, be it use technical, use fundamental, or whatever thing. Okay, now I want you to understand one thing. I say news and I put it at the amateur side. Okay, when I say news, I put it at the amateur side. This is because profitable traders, professional traders, they don't make decisions based on news. Okay, they don't make decisions based on news. Okay, so this is one thing that you need to know. I'm not sure how many of you can resonate with this, but if you always follow news, out of 10 times, maybe 7 to 8 times, you don't make money. Okay, if you realize, especially if you are in, smaller markets like Malaysia. All right. News are often not a good indication. Okay. It's slow. Even if it is a good news, price will always move first before the news announced. Right. So, and what's the quantity they often trade? Okay, what's the quantity they often trade? And this is the important thing that you will learn later. Okay, so for amateur right there, they always buy in round numbers, or they go all in. They got 10,000 ringgit, they buy one stock at 10,000 worth. Okay, or they're based on, instinct, or they're based on round numbers, meaning that I must buy 10 lots, I must buy 9 lots, I must buy 15 lots. Okay, they cannot accept like 5100 units. Okay, 5.1 lot, they cannot. Okay, I don't know why, but some people are like that. But for professional, okay, we use one thing called position sizing. And this is exactly what you will be learning later as well. Okay, this is what I call position sizing. So meaning that how much you buy is entirely based on the risk that you are taking for that trade. Okay, meaning that where's the entry and where's the SL, the stop loss. Okay, so how many markets amateur trades? Okay, usually one market, a single market or a single product. Okay, now I understand that this is just Bursa webinar. Okay, we are all from Malaysia. Okay, I assume so. Okay, so we always begin with Malaysia market, but it doesn't mean that as a Malaysian we cannot trade overseas shares lah. Okay, but start from one market is definitely great, but understand that a lot of professionals out there, they are dealing with multiple markets or multiple instruments. Like for example, if you deem that your strategy, okay, let's say whatever strategy you're using, for example, if you're trend followers like me, Malaysia market right now, really not a lot of stocks that you can, ride a big trends. Okay, so in this situation, you might just want to pick the best one. Okay, you don't have to go all out on your stock trading portfolio. You can go and trade other, FCPO, okay, things like that. Okay, so professional traders, profitable traders, they always look at other things as well, just in case one thing does not give them enough opportunity, put it this way. Now, the next thing is very important, especially for traders. Okay, amateur traders, what do they do when price go down? Can anyone type in the chat box? What do they do when the price go down? Okay, Peter said hold. All right. Anything else? They top up, they buy. Okay. Now, yes, average. So amateur traders, when price go down, they usually buy more. They're usually looking to buy and they average down if they already bought. Okay. And when the price goes up, okay, they will sell. Okay, they will sell. Just like one of my relatives told me last time. Okay, she said, the stock she bought, okay, went up by 5% in 1 month, and then she quickly sell. I said, why you sell so fast? Okay, maybe there's still upside potential because the momentum is there. Then she said, never mind, FD nowadays only give you like 3%, not more than 3% in 1 year. We human cannot be greedy, yada, yada, yada. Okay. And then when the stock goes down, she keep buy more. Okay. From 4 ringgit can average down until 2 ringgit. Okay. And then what's the point of risking like 50%, 60%, 70%? When you are wrong, but when you're correct, you only TP like 5%. Okay. This is what a lot of retail traders and amateur traders being trapped. Okay. Now, whereas for professional traders, okay, what do they do when price go up? They buy, they add position. Okay. They buy, they add positions. It's really opposite of what most people are doing. And when price goes down, they cut loss, they reduce position, okay, they sell, or even do short selling. Okay, you go with the trend. Okay, so it is just like a lot of time when the stock drops, you feel that it is cheap, then you buy, then later become cheaper. Okay, and there are always stocks that go up very fast, very fierce, very aggressive. we don't dare to buy. Okay. Of course, not asking you to buy those stocks, but sometimes the stock go up today, tomorrow, retrace a bit, then break new high again. We don't buy. But all these stocks, they always go higher. Okay, they always go higher. A lot of time, they always go higher. Okay, so these are the things that we need. As a trader, we have to back test, we have to relook into the market. Okay, so all right, so let's focus on today's agenda, okay, which is how you can manage our own portfolio like a fund manager. Okay, of course, the first thing, okay, when we talk about portfolio, the first thing is diversification. Okay, diversification. So here are a couple of tips, okay, on diversification. The first thing is, of course, diversify by what? Okay, diversify by what? Diversify with stocks. Okay, never go all into one single stock. Okay, that to me is actually gambling. So even if you have the confidence that the stock is one of the best one, okay, but you still, okay, have to look into, you know, diversification across different stocks to, just in case you are not right. Okay, because the market is always correct. Okay, we are not 100%. Okay, now, of course, you said diversify with stocks. You cannot have a portfolio, okay, that consists of, you know, Maybank, Public Bank, Hong Leong Bank, this kind of portfolio, or you have a portfolio of, you know, Top Glove, Harta Lega, Supermax, okay, or you have a portfolio of Amada, Dayang, Heng Yuan, Petron M. Okay, these are not great diversification, although you diversify into a couple of stocks. Okay, so the next thing is you diversify with sectors. Okay, you got to diversify into different sectors to lower your portfolio risk. Because if, let's say, you have 5 stocks and 4 of them are oil and gas related, then suddenly something happened with oil. So tomorrow you wake up, either you are very happy or you're very sad. Okay, so when the market is in a bull run with a specific theme, okay, you can choose to put heavier weightage in the related sectors, no problem, because that's when you need to focus on the theme. Okay, like for example, the 2020 second half, we talk about tech. Before that, we talk about glove. And earlier on, you know that we have like a lot of themes in the market, like export related sectors. That was when, you know, 1MDB is the case, and all the export related sectors becomes very strong because ringgit was very weak. Okay, it's in a weakening process. So you have a team, okay, you want to, you know, ride with the team, sure, okay, but diversify appropriately. All right, diversify appropriately. On the other hand, you also cannot over diversify. Okay, you also cannot over diversify. Now, the more you diversify, the benefits of risk reduction becomes less apparent. Okay, to the extent that your total return gets throttled. It's like if you have 20 stocks in your portfolio, then you might as well go and buy mutual funds. Okay, you get what I'm trying to say? Okay, if you buy like 20, 30 stocks, you might as well go and buy mutual funds because it's being throttled. Okay, the risk reduction benefits become less apparent. Now, I have a question to you. How many stocks do you think is a great diversification if we're talking about managing individual portfolio? Okay, like for your own portfolio. Some say 5, some say 10. Any more? 10, 7, 10. Okay. Any more? 5, 10. Okay. No right or wrong. Okay, no right or wrong. My personal preference is 5 to 7. Okay, 5 to 7. All right. So 7 being the max. Okay, 7 being the max. Okay. Don't invest until your portfolio can scroll. Okay, depends on investment sum. This is, to me, is not that appropriate. Okay, because we have position sizing, which is exactly what I want to talk about right now. Okay. If you think that you use 10,000 to buy one stock, then 50,000 you have to buy 5 stocks, then how are you going to manage a 300,000 portfolio? Okay. So it's going to be difficult if you always depends on investment sum. Okay. Of course, when you have like 1 million, 2 million, you can buy up to 10. Okay. But I would say anything more than 10, 15, you might as well just look into, ETFs, or you look into mutual funds, something like that, because it's not going to be easy to, manage. Now, if you're managing a trading portfolio, to me personally, my preference is 5 to 7, maximum 7 or 8. If you are managing an investment portfolio, which is bigger in size, okay, then 10 is acceptable. 15, I would say, is max, because beyond that, I don't find much meaning to manage it yourself. Okay. You can always find better choices out there. Okay. Mutual funds returns is not high. That is true. But if you try to buy 20 stocks, you will also realize that your portfolio return is not high. Okay. Because of what? Because, okay, the benefits of risk reduction become less apparent. Okay. The more you diversify, the less effects of diversification you get. There's a diminishing return when it comes to risk reduction. Okay. You guys can go and Google, okay? The diversification and over diversify and things like that. There's a diminishing return. Right. So the next thing is how much to buy. Okay, how much to buy. So position sizing is very important. And it refers to the size of a position within a portfolio, or the amount that a trader is going to trade, given the risk per trade and portfolio size. Okay, in layman term, it is how much to buy. Okay, how much to buy. Now, how many of you always got these worries? Okay, you look at a stock. Okay, I want to enter at 55 cents and my stop loss is 50 cents. The next question is, how much should I buy? How many of you have this question always in your mind? Okay, can you please type me, M-E? Meaning that you look at the stocks, you know where you want to entry, you know where you're going to set a stop loss, but the next question always bothers you. How much should I buy? If yes, you type me, M-E. Okay, meaning that, should I buy like 5 lots first? Or should I buy like 6 lots? Should I buy go double like 10 lots? Okay. So if you have this problem, okay, this issue, position sizing will solve your problem. Okay. So now position sizing is an important risk management technique used by portfolio managers and professional traders, and as it controls the risk. Okay. Exposure for the portfolio. Depends on the stock price, $20 or $50 per share. No, it actually depends on your risk. Okay, of course, the larger or the higher price tag the share has, you're going to buy less. But I'll give you a more systematic way of doing things. Okay, so the formula, guys, write this down, the formula. Your portfolio size times risk per trade. Okay, times risk per trade, divide by your entry minus stop loss. I repeat, your portfolio size times risk per trade, divide by entry minus stop loss for that particular stock. Okay, now, let me explain one by one. Now, portfolio size is, what is your portfolio size? What's your capital? What's the money you have in that portfolio? Okay. Now, second, what is risk per trade? Now, risk per trade should be fixed. Okay. Risk per trade should be fixed. Now, for example, you want to buy, you set a risk per trade, let's say 1%. Okay, let's use 1%, meaning that I don't care this stock is Nestle or it is Sapura Energy, as long as you hit a stop loss, your portfolio drawdown is 1%. You understand what I'm talking about? Let's say you got 100,000 portfolio, regardless which stock hit your stop loss, you lose about 1,000 ringgit. Your portfolio drawdown is 1%. All right. So the risk is always fixed. Don't get overly attached with any stocks. Okay, so next, entry minus stop loss is where you want to enter the specific stocks and where your predetermined stop loss level is. So let's say the example. Now, Mr. A has a portfolio value at 100,000 based on net liquidation. His risk per trade for this portfolio is 1%. Now, Mr. A wanted to take a position on stock AAA. The entry and the predetermined stop loss is 5 ringgit and the stop loss is 450. Now, based on position sizing, how many units of stock AAA Mr. A should buy? Come on, give me the answer. Okay. So this guy, portfolio 100,000, risk per trade 1%, and now he wanted to buy a stock. Okay, this stock is stock AAA. Okay. So entry is $5, stop loss 450. Okay, so how many units should he buy? All right, quantity, units. So the formula, 100,000 times 1% divided by $5 minus 450. So he is going to buy 2,000 shares. Okay, 2,000 units. I don't want to say lot because to some people, one lot is 1,000 units. To some people, one lot is 100 units. Just avoid confusion. Okay, so 2,000 units. All right. So how it works? 2,000. How it works? So Mr. A will enter 2,000 units of stock AAA at $5, using up 10,000 ringgit of his buying power or capital. Now, should stock AAA drop to his predetermined stop loss of 450, he would then sell the 2,000 units of stock AAA and get back 9,000 ringgit. Okay, the loss would be 1,000 before fee, of course, and his portfolio value would drop by 1%, which is AKA the predetermined risk per trade. All right, so if stock AAA go up and he sells at 6 ringgit 50 cents, for example, he would then sell his 2,000 units of stock AAA at 650 and get 13,000 ringgit, for example, okay, which is a profit of 3,000 before fee. So his portfolio would grow by 3%, or in other words, the risk-reward ratio for this specific trade is 1:3. All right. So in the world of professional traders or fund managers, risk is quantified in this way, and this concept is what I call risk multiples. Okay. So if a share go up from 5 ringgit to 6 ringgit, okay, now it's a 20% gain. But if you talk to a portfolio managers, 20% gain, so what? Okay, so what? You got to tell him how much you risk to make this 20%. If you risk 50% to make this 20%, this is a lousy trade. Okay, this is a lousy trade. So go back to the previous slide would be this. So the formula is this: position size times risk per trade divided by entry minus stop loss. Okay, your entry minus stop loss. Now, go home, or not go home, later after this webinar, I want you guys to take, do some exercise yourself because I have limited time. Okay, so now, this example, the entry is 5, stop loss is 450. So it's about 10% stop loss. Now, if your stop loss is less than 10%, for example, your entry is 5, your stop loss is 470. Okay, your units will go up. So when your units go up, you would use more money, okay, to buy one stock. Okay, you use more money to buy one stock. Now, you might say, okay, if I only use 10,000, then I have 100,000, I can buy 10 stocks. Well, then I ask you a question. Do you always risk 10% in one stock? Because some people, they are swing traders. Okay, maybe they buy a stock at $5, their stop loss is 480. Then in this case, how much units you are buying and how much of purchasing power you will be using up. Okay, so ideally, okay, at the end of the day, from a practical manner, okay, you will always buy like 5 to 7 stocks. Okay, if your stop loss is around 4 to 8% on average. Okay, 4 to 8% on average. Okay, so okay, now the next thing that I want to talk about is when to add or reduce position. And when to add or reduce position. So when not to add and when to add. Okay, so one mistake that many retailers intuitively, sometimes by intention, is averaging down when the stock go against them. Okay, given that capital is finite and limited, especially for retailers, so averaging down is never a good idea. Okay, it is not like you go to casino. Okay, if this round you lose, you double up, double up, double up, double up, double up until you win. Okay. Theoretically, it will work. Okay, it will work, but understand that the caveat is you got unlimited capital. Okay, so as retailers, we don't have so much capital to do averaging. Okay, so adding position on a losing stock means that more of your already limited capital will be stuck in a losing stock. Okay. Probability wise as well, stocks that are going down will carry higher probability to go down. Okay, because you're going against the trend already. So adding positions and pyramiding when a stock is going up is a general practice. Okay, so pay close attention to your new average cost and your trailing stop. Make sure when your trailing stop is hit, you will not end up with loss. Okay, now let me explain this. So for example, you buy a stock at 3, okay, and your stop loss is 270, for example. Okay, so let's say based on position sizing, you buy, I don't know, 10 lots, okay, 10,000 shares. So when the stock go up to, let's say, 385, you want to buy. Sure, no problem. Okay, you set your trailing stop below this the swing low. So you move your stop loss upward. So for example, your new stop loss is 350. Okay, your stop loss is 350. Oops. How come like this? Okay, 350. All right. Now, okay, you're going to make sure if the stock comes down, hit 350 or trailing stop, you will not end up with loss. This is the criteria of adding position. Okay, this is the criteria of adding position. Usually, you would have to buy less than your initial size. Okay, you need to buy a lot less than your initial size. Okay, so how about reducing position? Okay, so the objective of reducing position is always to minimize risk. Okay, when there's high volatility or uncertain situation. So I'm going to reduce position when stock gap down too much. Okay, usually you realize that gap down and it runs lower, then it's never come back already. Okay, or when the market or the sector suffer, unusual volatility, or suddenly the stock dropped 8% in a day, although I haven't reached your stop loss or trailing stop, you might want to consider, reduce a little bit position. Or you are emotionally not comfortable with the movement of the stock. Okay, this is also when you should be reducing your position. And when the stock has been going sideways or non-performing for a period of time, and you reckon that there are better opportunities out there in the market. Okay, now tonight's our topic is mainly focused on how you can trade or manage your portfolio like professionals. Okay, so how do you implement all these into your own trading system? I cannot give you an answer because I teach you how to manage your portfolio, but I don't know your strategy. Okay, so you got to create your own trading system, and I will give you a couple of guidelines. Okay, I'll give you a couple of guidelines. Okay, so first, you're going to gather your commonly used, indicators or rules or things along those lines. Okay, you can create your own trading system based on the strategy you use, the indicators and rules that you use. Okay, how comfortable or uncomfortable you are given. Okay, in a different kind of scenarios. Okay, now the first thing is, what is your buying rules? Okay, what is your buying rule? For example, okay, I like to buy a stock only if it is uptrend. Okay, so the uptrend in my definition, okay, one of the criteria is the EMAs must be in sequence. Okay, I don't care you use what EMA is, but I know that some of you are going to ask, hey, what EMA is this? Never mind, I give you 20, 50, 200, but it can be any. Okay, so I want the EMA in sequence, and then I want to see the stock break new high, come back down to challenge this EMA, any EMA, and go up. And I will plot my first entry. Okay, I will plot my first entry. All right, so this is my criteria, okay, to buy. Now, what is your criteria to sell? Okay, what is your criteria to sell? Then you can set yourself. Okay, for example, if the stock has gone up a lot and it always respects certain EMA, in this case is the 20. When it closed below 20, okay, I would take profit half. Okay, I will take profit half. And the rest, I will take all when it breach the next support. So in this case, I'll take profit here and it goes up, did not break new high, come back down, I will sell here already. Take everything. Okay, take everything away. So this is my buying and selling criteria. Okay, so your buying criteria can also involve, for example, when you see some EMA crossover. Okay, some EMA crossover. So for example, when this crossover, you can also set, you buy maybe 1/3. Okay, when it breaks new high, come back to challenge any support and rebound, you buy another 1/3, something like that. Okay, then you only go full blast when the EMAs are in sequence, meaning that you're whatever 20, 30, above 50, 200, and then comes back down, breakout, comes back down, boom, then you buy all. Okay, then you only enter your full position. You can also create rules based on this. Okay, so again, I just want to say, if your current trading rules or trading strategy is already correct, meaning that you know that you are profitable, then you can implement this rule and create your own SOP. So today, no matter your portfolio is 100,000 or 300,000 or 1 million, you use the same rule, you can grow your portfolio by percentage. Because after all, it's a percentage game. Okay, it is a percentage game. All right. So again, like for example here, you see, what is my buying criteria? My buying criteria is EMA must be in sequence. So I wouldn't buy here. 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 I wouldn't buy here because the EMA is no crossover. And I wouldn't buy, wouldn't buy, I wouldn't buy, I wouldn't buy. Of course, it's not only my criteria, okay? So to buy back stocks like this, I got my own SOP as well. Okay, now, for example, this one, EMA in sequence, boom. This one I don't like because it's EMA 200. Okay, now here goes a challenge. I also don't dare buy lah. Okay, to be honest, I don't dare to buy. Go sideways, breakout. Okay, breakout, I like. Okay, then what I want to do? Okay, how do you trade breakout? Breakout, come back, you buy here. Because this is resistance, turn, support. Very simple one. Okay, how do you usually enter stocks? Okay, then you set your own rules. Okay, and then goes up. Okay, you hold here. I'll take half. Okay, take half. So from here until here is already quite a lot. Okay, and then the rest I wait until it goes up, goes like this. Okay, boom, sell, 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 sell. Okay, get out from the stock. So if I want to buy back this stock, these two lines have to cross, then retest back whatever thing that I want. Okay, whatever thing that I want. Okay, so again, create your own trading system. So Chin Hin, how to buy? Okay, Chin Hin, how to buy? Criteria. Okay, let's say here I didn't see it. Okay, miss the stock. Then it goes sideways, breakout. Okay, comes back. Okay, hit, buy. Go up, break, here, buy more. Okay, why I say buy more? Because this stock, okay, when you look at this stock, okay, if you sell here, also can, because you already buy here, then you sell somewhere here, maybe you have to buy back later. Okay, so you create your own rules. Okay, when the stock go haywire like this, of course you buy, sell, buy, sell, buy, sell, but this is also challenging your own trading system. Okay, and also how do you usually buy or sell? Okay, yeah, yellow is 20. All right, so you can see a lot of stocks give you a hint. A lot of stocks always respect this one. Okay, so when the stock moves very fast, okay, it will respect like maybe 20. When the stock is slowing down, 50 is the one that it will usually respect. If it doesn't respect, that stock usually no power already. Okay, then how are you going to set buying and selling criteria based on that? And how do you control your size based on that? Okay, how do you control your size based on that? Okay, so those are ways that you can set or craft your own trading system. Okay, based on position sizing rule. Okay, so you got to understand one thing. In the world of professional trading, is always risk and risk multiple. Okay, it's always risk and risk multiple. How much do you risk to make 50% gain? How much do you risk to make that 20% gain? All right, so your risk multiple must be intact, must be, correct, things like that. All right, so that would be all, and I'll open up, okay, for Q&A. Okay, so Shane, are you there?
Yes, thank you so much, Jin Hao, for sharing with us the ideas and strategies that retail investors can use in terms of how we can manage a portfolio like a fund manager. So I think just now, many of us here have learned the tricks from Jin Hao, as well as some math, some formula that can help us to determine what kind of lot size that we are supposed to use, what kind of risks are we supposed to take. So if you have any questions, ask our speaker, Jin Hao. You may write them in the Q&A box, not the chat box, so we can address your question effectively. So write them in the Q&A box. So the first questions is, how do we justify cut loss in the portfolio? How many percentage down if that counter does not have a potential growth? And any range of the portfolio is worth to do accordingly?
Okay, now I don't have a definite answer because risk appetite is, depends on yourself. Okay, I am a trader. Okay, when it comes to Bursa stocks, I'm more of a trader. So to me, I like to trade stocks above 2 ringgit. But if let's say I have to trade stocks below 2 ringgit, I usually wouldn't trade stocks less than 50 cents. Okay, because overly volatile. And for stocks between 50 cents to 2 ringgit, my stop loss first is based on technical. Second is based on, not more than 10%. Okay, it's based on technical. I can show you an example per se, okay, just to give you an idea. But again, this is how I trade, not like definitely you have to use this way lah. Okay, I can share with you. Let's say if I were to buy into Pelican. Okay, Pelican. So I look at this. Okay, so how many of you might see this is a bullish engulfing, for example. Then if you use bullish engulfing, what is your stop loss criteria? If you use EMF 50, then it should be below here. 10%. Again, this is a less than one ringgit stock. Okay, 10%. All right. What else? What else we have? Okay, let's see. Let's see if we have any other. This one. Personally, I don't like lah. Okay, stocks that are full of. Okay, let me just put it this way. Okay, let's at Chin Hin. Assuming I want to buy on this rebound. Okay, where will I put my stop loss? I will put it below this low, and this low also below EMA 20. Okay, so let's say I buy here, 6%. Okay, 6%. All right. So this is how depends. Okay, depends. So I would say that I usually do not like to risk more than 10% in the stock. Okay, not the portfolio, the individual stock. Because you got to understand one thing. If a stock drop from 1 ringgit to 90 cents, this stock need to go up by 11% in order for you to break even. Now, let's say if there's a 1 ringgit stock, it drops by 20%. 1 ringgit to 80 cents. Now, this stock has to go up by 25%, okay, in order for you to break even, not to make money. So, to me, stocks below $2, max 10%. And stocks above $2, usually I can get by with like 6 to 8%. Okay, hope that gives you a little bit of idea. But this one is just for trading, okay, for trading.
All right, thank you so much, Jin Hao. So Jin Hao, what do you think if we have a portfolio of 1 million and above, how many companies or counters should we have in the portfolio?
7 to 8.
7 to 8 for 1 million and above.
Okay, now, and you also need to be one thing you need to be very careful is if you are, because let's say 1 million, okay, you need to be very careful with low float stocks, meaning that when you buy, okay, let's say you want to buy, let's say 150,000 worth of this share. When you want to buy that stock, you look at the bid and ask, you realize you keep makan people's queue, then you know that this stock is not for you. I don't know how to explain. Meaning that the open interest is not a lot. Okay, the open interest is not a lot. Then you need to be a bit careful if you deal with that stocks. Meaning that you are going to buy up a lot of that days, at least the queues there. Okay, so that's the thing.
All right, thank you, Jin Hao.
Still 7 to 8 Okay, still 7 to 8.
How about for portfolio that is there's less than 100,000?
I will still say, okay,
also 7 to 8.
5, 6.
5 to 6 for 100,000 and below.
All
right. So how do we calculate risk multiple? So that's by Brandon.
Okay, risk multiple is not something that you calculate, but you need to have this thing in mind. Okay, how much you risk to make this return? Because a lot of people are not really aware of this. So risk multiple is this. If you always risk 1 to make 2, okay, you always risk 1 to make 2, meaning that if your SL, your stop loss is 6%, your TP, first TP is 12%. If your first if your asset is 10%, then your TP is 20%, something like that. Okay. So if you have a risk average, risk multiple of risk reward ratio of 1 to 2, then every time you cut loss, your portfolio will, let's say your risk per trade is 1%. Okay. Then every time you lose, your portfolio will lose 1%. But every time you make money, your portfolio will gain 2%. Okay, this is what I call risk multiple. And you have, let's say you have a big wins, then how many R is that? Okay, so let's say if you buy a stock at 10 ringgit and your stock loss is 9 ringgit and the stock goes from 10 to 20, then what's the risk reward? Then we call it 10R. Okay, we call it 10R. Okay, so this is how a lot of time we talk to portfolio managers and we talk about this specific position. So they wouldn't ask you straight away, what is your portfolio size? How much you make? Okay, this is not how portfolio managers talk to each other. And how many millions you make from this trade? Okay, unless you're a close friend. So the first thing we ask is how many R you get in this trade? Okay, how many R you get from your top glove? How many R you get from your Supermax? How many R you get from your whatever stocks? Okay, gain, because lose is always 1R. If you lose more than 1R, meaning that extended loss, okay, extended, or meaning that you buy a stock at 1, your stop loss is 90 cents, then the stock gap down to 85 cents. Okay, that one is extended loss. Okay, you also need to put that into consideration. So it is more like a concept that a lot of people don't know. Okay, it's not something you calculate, but because it's just risk reward ratio, and we put it into a portfolio atmosphere. All right.
All right. Thank you so much, Jin Hao, for addressing the question. So the next question is by Ang. How do you calculate position sizings when you add position?
Okay, thank you. I've been waiting great questions like this. Okay. Okay. Let me just illustrate with whiteboard. Okay. How do you look at what's the question already?
How do you determine the position sizings when you want to add position?
Okay. First, you also need to, when you add, it's not like you blindly add. It need to fit your certain criteria for you to add. For example, you always buy stocks on, breakout, pullback, buy, things like that. Okay, so let's say the first position you buy is here, the next is here, the next is here, the next is here. Let's say there's a rebound. Okay, so you need to have valid reasons to buy as well. Now, okay, let's put in some numbers. How do you buy? Okay, the simple rule is first pyramid. So what is pyramid? Pyramid means, let's say at the bottom you buy 10,000 units. Here you don't buy more than 10,000. Maybe you buy 7,000. Okay, maybe here you buy 3,000 units. Okay, now to put in more numbers, let's say you buy a stock here. This is your first position, is $2 and your stop loss is 1.8. Okay, your stop loss is 1.8. And let's say, I have to pull out a calculator already. Okay, so let's say it's 100,000 portfolio times 1%. So it's 1,000 divided by 20 cents. So you're going to buy 5,000 units of this specific stock right here. Okay, so let me just put in. You're going to buy 5,000 units. Okay, now 5,000 units at $2, you're going to spend, okay, 10K. So far, I hope you're still with me. Okay, now let's say if the stock were to go up to, let's say here, you want to buy. Let's say it is 280. Okay, and then your new stop loss is 250. 250. Okay, so you have to move first. You got to move your trailing stop. Every time it goes up one wave, you have to move. Go up one wave, you have to move. Go up one wave, you have to move. Now you got your new entry. You got a new stop loss. Now The first rule is don't buy more than your initial units. The criteria is this, don't buy more than your initial units. Now, let's say now you want to buy 5,000 units or so. You said, this is a great stock. I want to max out the potential. Okay, buy 5,000 units. Okay, 5,000 shares. Now, you got to calculate your new average cost. Okay, your new average cost. But of course, 5,000 units plus 5,000 because it's the same units here. So it's 2.8 plus 2 minus divide by 2. So your new cost is 240. Okay, your new cost is 240. So your new cost is 240. If the stock really holan you, go up, then boom, hit your trailing stop. Then you are not losing money. This is the only thing that you need to take care when you add position. Is that clear? Is that clear?
Yes.
I hope it is clear. Hope it's clear. Okay.
Thanks
now, okay.
for illustrating this.
Yeah. So let's say this is not 5,000. Let's say this is 4,000. Okay. Then how you calculate? So very simple. Your 5,000 times 2, your entry price, value is 10K. Then this one, 280 times 4,000. Then you get how much? 280 times 4,000 shares. Okay. 11,200. This is your new position value plus your original cost, 10,000. Divide by total number of shares after you add, which is 5,000 units plus 4,000 units. So you divide by 9,000. So your new cost is 2.35555555. Okay. So if you hit your trailing stop, 250, no problems. You still got 15 cents of gains per share. Okay. I hope it's clear now. Okay.
Thanks, Jinhao, for illustrating this.
Okay.
Stephen would like to ask, if the price of the stock has gone up too high, should we not wait for retracement to buy or add position rather than buy and add position directly when it has already gone up so much?
Of course. Like I said, when you buy position, you add position, it also has to fulfill your own buying criteria. It's not like you buy for the sake of buying. You have to have your own buying criteria, like why you want to add positions. Is it because the stock is still strong? It's still steadily going up? Okay. And things like that. Okay. If it is still smoothly going up, is good uptrend, okay, then you can add. Of course, you don't add stocks when it drops, like, limit down today. Okay. You want to add. Cannot, okay? Because it's definitely dangerous. So you need to know how can you, based on your own strategy, okay, how can you safely add positions as well? Okay, how can you add positions safely? It's like, how do you determine, okay, it is safe, or based on your own analysis, it is okay. Okay, it is okay to add position, things like that. Okay, you need to have your own analysis. I put in this way. Okay. Yeah.
All right. Thanks,
it's not like
Jinhao.
blindly add lah. Like the stock gap up, then you add. No.
All right. The next question is by Peter. Do you look at other indicators in trading?
Of course, I look at other indicators, but not a lot. MACD only.
MACD
and
only.
Sometimes RSI.
All right. Thanks, Jinhao. The next question is by Ang is that, is your definition of uptrend stock is higher high and higher high?
Higher high, higher low. Not only that. And not only that. The first is I want the EMA to be in sequence. Okay, I don't care what EMA you use, there has to be in sequence. So if a stock is under EMA 200, definitely I will look at it. Okay. The second thing is I want the stock, at least for the past 2 to 3 months, it is breaking new high. Okay, it is breaking ideally like 1-2 months high. And also I prefer stocks that are at the all-time high. or at least 52 weeks high. That would be the best. Okay, that would be the best.
Okay.
So I just write the trend. But I know a lot of people don't trade these kind of stocks. They will say, oh, you chase high, things like that. Not really. Okay. If you study trends, then a lot of time these stocks tend to go higher. But if you would ask me what's the basic criteria, of course, the EMAs must be in sequence.
So the EMA must be in sequence. It's more important than whether they demonstrate higher high, higher low lah.
Yeah, because sometimes high low, it can, suddenly it spike a little bit, give you a lower high, then it goes up again.
So what if there are, like, let's say there are a couple of EMA and two of them are not in sequence, but two of them are in sequence. Will you consider this in uptrend stocks?
First, I will see where is the 200.
Okay,
I will see where is the 200. Some people use SMA, some people use EMA. But let's say this is the 200. Okay, and then price is above 200. Okay, price is above 200. Also, okay, I think Ang asked what is in sequence. Okay, what EMA you use? For example, in my example just now, I used 20, 50, and 200. So 20 must be above 50 and 50 must be above 200. This is the basic criteria. Okay, now what Shane was asking, I think, was something like, if let's say something like this. Am I right?
Yep.
Okay, I will wait until it cross up.
So you must make sure that it is in this kind of sequence.
Yes.
Okay. And the best is they are at all-time high.
Yeah, but of course, it's not like break all-time high, we straight away buy lah.
Okay, so got to wait for retracement lah. That's a strategy, right?
Wait for retracement to, suitable levels, things like that. Because let's say if a stock retrace back to, EMA 20, 50 in an uptrend, it is a cheaper price to buy in an uptrend, as opposed to when the stock is flying very high and is very, detached away from the EMA 20.
So Peter would like to clarify, even if it is at all-time high at above 70 RSI, the reading, RSI reading.
Okay, I think I saw another question. I think I will address this question as the last question for tonight.
Okay.
Definitely you guys will learn something. Okay, if you guys don't learn something, you knock my head. Now, RSI. Let me ask you one thing. Okay, I want you guys to answer me this question. RSI 70, and then 30. Based on textbook, when it goes to 70, should you buy or sell? Type in the chat box. Should you buy or sell? Based on textbook lah. Okay. Your job tonight, okay, after closing this webinar, is to go and flip some chart. I can straight away tell you, every time when RSI spike to a very high, you sell, you regret. Okay, you sell, you regret. Let me show you. I will prove it to you. Okay. Yeah. I'll prove it to you. Okay. Let's wait. Okay. Okay, so this is how you see RSI a lot of the time. Okay, this is how you see RSI a lot of the time. Okay, I actually only teach this to my student last time. Okay, so of course, in a proper trading system, okay, in a proper trading system, we do not use RSI alone. We also use MACD. Okay, MACD. Okay, and I usually RSI is not the first thing that I see. The first thing that I see is the trend itself. Okay, is the trend itself. Okay, now what I want to see is the trend itself, no problem. Okay, the trend itself, no problem. Now, here, the first thing, like I said just now, the first thing I want to see is what? The first thing I want to see is the EMA in sequence. Here, EMA not in sequence. Usually I would not buy. So after that, here to the right, EMA in sequence. Okay, EMA in sequence. Now, when it drops here, based on my rule, this is passable, but RSI is not high enough. Okay, it's not really high enough. I will tell you where I buy is here. Okay, where I buy is somewhere around here. When MACD cross or slope up, and when RSI go up, you listen carefully. When RSI goes up, and you see what happened after that. The stock go a lot higher. So from here to here, the stock go up highest to 18%. I give you another tips. Okay, how I use RSI is I change the lower limit to 40 and I change the upper limit to 60. Okay, now every time I buy into a stock, I want to make sure the RSI goes above 60. And the MACD is above 0. And the trend is good. Okay, trend is good means EMA in sequence. The 20 is above 50, the 50 is above 200. And then MACD is above 0. And the RSI is strong. I preferably don't buy stocks when RSI is weak. Okay, and let me show you. Okay, let's just take glove lah. Okay, because everyone know glove go up ma. Very simple one. When glove is going up, do you realize that the RSI never dropped below 40? Yes or no? If you see yes, can you please type yes? I don't know whether you see it or not. The RSI never dropped below 40. And some people say we have to wait until it drops below 30, then it is, you know, I don't know what, overbought, under whatever thing. Okay. Now, when you see here, okay, RSI go up. You sell the stock when RSI is 60, 70. You sell it because based on textbook, it is, you know, overbought and things like that. I guarantee you regret. I guarantee you regret. Okay, so and then here is very, very, very obvious also. Okay, when it drops below 40 is where the momentum really gone. Okay, momentum really gone. So the first thing I always see is the trend itself. The second thing only I check with MACD. And the third thing I see is I check the RSI to know the strength. So is it RSI high that you have to sell? No. RSI high, I buy. Okay, to really tap on the momentum. You guys can go and back test a lot of time. Okay, a lot of time. RSI, of course, you see here, it goes up 60, go up 60. Can you buy here? The answer is no, because first criteria to me is always the trend. Trend is not there, no need to say the next thing. Okay, you can go and see the strong stocks. When they are strong, what is the characteristic? the first thing you see is the MACD is always above zero. Okay, it's always above zero. When it is weak, then it goes below zero. Only when it is weak. When MACD go above zero is when the momentum starts coming back in already. Okay, so I also don't agree that MACD, golden cross you buy, that cross you sell, golden cross you buy, that cross you sell. Then here you get a lot of like false thing lah. Like here you sell, here you sell, then after that the stock fly. Okay, so you got to understand what the indicators really is instead of just blindly follow. Okay, MACD, golden cross you buy, that cross you sell. No, it's not like that. Okay, so again, RSI is for us to know whether or not the strength of the trend is there. It's not like 70 or 80 or 90 you have to sell. Okay, sometimes, okay, it can maintain very high. Okay, it can maintain very high for a period of time. Okay, you see JHM. Okay, it can maintain really high for a period of time. Okay, from here to here, when it breaks 60. Here to here. Okay. You see, when the RSI is high, the stock go up about 50 to 60%. Okay, so indicators should not be your only thing to tell you whether you should buy or sell certain share. To me, what's more important is price action. Indicators are just AID, okay? It's just there to give you additional information. What's more important is actually the price action. All right, the price action. Like for example, what's the stock that go down a lot? S start from Salute, is it? Nah, RSI still higher. And then what about MACD? MACD still haven't that cross, or then you should not sell based on indicators. All right. So remember, indicators are just there to help you a little bit here and there. It's not everything. Okay. In fact, if you can trade without indicator, that is going to be the best. All right. So to really use one indicator, you need to know how price performs in relation to what the indicators show you. Because a lot of people have been telling me, okay, RSI 30, you should buy. And then later 30 become 20. Okay, 20 become 16. Okay, so you got to understand how the indicators is formed. Okay, go and search RSI, Relative Strength Index, how it is being calculated. Okay, then you understand why I say when RSI is high, you better look into buying. Okay, of course, first is trend, price action, then only whatever your MACD stochastic RSI. All right, so that's the thing that I can share with you. All right.
Thanks, Jin Hao, for sharing with us some of your strategies when it comes to using indicators such as MACD and RSI. So with that, we'd like to conclude the Q&A session with Jin Hao. So thank you so much, Jin Hao, for sharing with us your strategies in this session.
Thank you. All right. Hope you guys enjoy your session as well.